After some lackluster employment numbers, the market took a little bit of a dip. But is the economy cooling off, or should we expect more rate hikes later this year? Riz and I are going to discuss it. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. My name is Chris. I'm part of Riz International, and we are a group of traders who are looking to make our money work for us and not the other way around. And if that sounds like something that you want to accomplish, make sure you click that like and subscribe button down below. Hit the bell icon to get notified every time we upload a new video or a webinar so that you are on the forefront of market knowledge that you are not going to hear anywhere else. Now, we are joined again tonight by the man himself. Riz, how are you doing this evening?
Doing good, Chris. Yourself?
Doing great. Glad you are here because it has been an up and down week, to say the least. Obviously, we started off Monday rather hot on the S&P 500 with a massive run-up back again over our channel after we had dipped back down into it. Tuesday and Wednesday were not really too much of anything going on, but then Thursday and Friday we had a lot of movement in the market. Big gap down on Thursday, and then we bounced back up, hit the top of our moving average, our channel that I've drawn, and then a really hard rejection on Friday. So, Riz, it's been a pretty wild week, to say the least. What are we thinking as far as what's going on here? I mean, obviously we're looking for more downside. We really stayed like right here at this 4,400 resistance and support area, and we don't seem to be able to close below it.
Yeah, so we've talked about this 4,400 level for the past week and a bit. It is pretty crucial. I wouldn't say it's the most strongest or long-term key point, but it is crucial. It is a bit of a pivot point, as we can go back and see. It's been an area where the market has pivoted a lot, has had a lot of drawdowns or breakouts from. So that's what we kind of call it, as a pivot zone. It's not the long-term, 4,000 or 4,100 level like we've seen before, but it is something important. And even in regard to your channel, it's a key level there as well. So a rejection of that is definitely, without a doubt, bearish. And I mentioned that in Elite that, okay, this 4,400, if we can get a break below, it's going to be bearish. But here's the thing. It wasn't as negative or as strong of a push downwards as expected or as needed to give that clear bearish signal. Like, we had a clear bearish signal when on the week prior, when we broke strongly below the 4,400 level, and then it kind of found a floor around, 4340 or something, and then picked right back up. Classic dip buying there. So unlike that, it wasn't as strong. I do think because we closed below the 4,400, just a smidget, excuse me,
bless you,
just a smidget below, I do think it's bearish, especially the close, like that candle, Chris, on Friday.
Yeah. Mm-hmm.
Very bearish candle. And of course, as for those that were watching the price action, it was pretty brutal. Like, we kind of had a very choppy early morning, and then in the afternoon it was kind of green, and then literally in the last half an hour of markets that week on Friday, it was just the last half hour that really pushed the bearish. Like, I don't know exactly what happened. It's just price action or funds and institutions just taking off risk. But man, it was kind of brutal to see. So anyone that was kind of thinking, okay, well, we're going to get a pick up above, kind of got slaughtered, especially with, see that wick there, just right at 4440, kind of top there. So definitely bearish. Again, RSI also pointing as such, drop after being overbought once again. Apart from that, I think we're kind of trading in a very odd market because we've had some macro related stuff come in strong in regards to the economy, but that does kind of end up being a bittersweet thing when it comes to markets, because a strong economy essentially guarantees that the Fed in the next rate hike, which is I think in 2 weeks, will raise rates by 25 basis points.
Yeah, and Powell has alluded to that as much, that we're still looking, for more potential rate hikes. Obviously, there was a pause last time where they didn't raise it, but they didn't say that they weren't going to raise them for the rest of the year. I think a lot of people might be betting on rates not going up anymore, and I think that they would be sorely mistaken. I think percentage wise at this point. For that to happen, I should correct myself real quick because I got my weeks mixed up here. I apologize. So this was actually Friday's candle, and then we had a short trading week this week, of course, because of Independence Day here in the United States. So my mistake on that earlier. Just wanted to correct myself. I'm sure that people have already corrected me down in the comments, but please feel free to tell me how wrong I was about that. So yeah, obviously a lot going on this week. Obviously with the shorter trading week and kind of some not much going on prior to that, and then everything happened in the back half of the week, obviously on Thursday and Friday. So a lot of movement there. It should be an interesting week, and you'll see why here in a few minutes when we get to the critical dates for this week. But let's take a look here at the breakdown for the S&P 500 so far this year. Let me get that back on year to date. My mistake there. Obviously, tech is just riding high at this point, really going nuts here. I'm not quite sure what has happened to my chart here, why it's not displaying all those. I apologize for that, but we'll get that fixed after the webinar. Communications going very nicely as well as consumer discretionary. Still, basically in the same place that we were last week, just maybe a little bit higher. But we are starting to see some cooling here in tech and communications and discretionary for that much as the market kind of dipped back down into that channel that we had on the previous slide. Obviously, the other the other indices are not performing as well lately, but we are seeing some movement there. For the most part. But honestly, I kind of feel like a broken record, Riz, at this point. We haven't seen a big, shift so far in any of these different sectors at this point, if I had to say.
Yeah, these sectors, I mean, just kind of consolidating, nothing major to be gleaned yet. I can't say we've seen like a massive sector rotation. We haven't seen anything major. We haven't seen a massive breakdown in any one sector like tech. We've just seen kind of everything kind of channeling lower a little bit, except I believe, what is that? I think that's yellow. Damn, that's hard to tell.
Energy.
Yeah. Okay. Energy picked up a little bit. Apart from that, everything else is kind of curling lower. So interesting to see. Usually, I feel like because if it was one individual sector, such as utilities or anything like that, I'd be able to kind of say, okay, maybe we're going a little bit more of a risk off. But the fact that everything is down, everything's curled over a little bit, and the only thing that's kind of up is energy. That could be, the outlier. Maybe not much to be gleaned from that, but other than that, I think it's kind of subpar.
Yeah, for sure. Really not too much here to talk about, but we are seeing oil here on the asset classes starting to perk back up a little bit, but still really just stuck in our channel at this point, really right between the 68.50 approximately and, I'd say about 82, 81, 85, somewhere in that range. We're getting this, just this channelized movement in oil so far this year for the most part. Not really moving too well. Gold is also kind of stabilized here after a real hard rejection of the all-time high back in May. We've been selling off quite a bit in oil, but this week mostly a trading sideways. That could be partially attributed to the shorter trading week, obviously, with not as much volume. But yeah, are you hearing anything going on in oil, Riz, at this point, or is it just more business as usual?
No, we've seen, OPEC and Russia even commit to more cuts through the month of August. Before they said, we're going to cut production, but they hadn't given a timeline. But now they said for sure it's going to be through into September. I reckon they're going to be extending those cuts even more with the potential for even a little bit more of an increase in, or I should say decrease in production. So that could definitely play into the hands of a stronger price per barrel. What's interesting, I will say, is, or not interesting, but what is important to understand is, especially for elite members that already know, we did take a long oil position, not directly, but via stock. I'm not going to, of course, disclose that because that's for elite members only. But the long position we've taken is there. Again, it's a swing trade, not looking to just get in and out of that too quickly. We have a little bit of energy exposure with the pipeline and this pure play oil company. So I'm pretty pleased with that. I think they will do well in the intermediate term. Again, very tough to say with the long term, but I think intermediate term we can do decent, especially if oil goes to above the cracks above that 76 area. It can definitely move up into the 80s zone, and that should hopefully, fingers crossed. I don't want to say hopefully, but that should play into our hands with our long positions.
Yeah, definitely. If they start cutting production, obviously the price in theory should be pushed up because we have a lower supply. Demand is either the same or going to be higher, which would command a higher price point. It's all about supply and demand curves, guys. That's definitely a big part of it. So keep an eye on that. Let's take a look here at the bond yields so far. So we have been seeing a huge run up in these 2-year bonds, and it just kept going this week. But I will say we did see a mirrored move here in the 10 rather and the 30-year, which we hadn't seen in the past. Before, we had this big move in the 2-year bond, so there's quite a discrepancy here in the yields between those two. But at least this time we're starting to see those longer-term bonds start to really perk up, which, in my opinion, I feel like that would signal that, investor, confidence is starting to grow that, these bonds will pay out. But Riz, what are your thoughts on that?
I would say the market is now pricing in higher rates, as I alluded to, and I said this would happen. Even before this past week, that look, we could see higher rates and higher rates for longer. So I think the bond market, especially, is now catching up to that fact. Especially with we had some good numbers from a macro standpoint, which further, like I said, reinforces that Powell will increase rates. And instead of actually having a rate decrease, because the stock market, not the bond market, but the stock market was alluding or pricing in rate decreases, rate cuts.
Mm-hmm.
I don't think that's the case anymore. And I think the market now has to price in the fact that, or reprice in the fact that, look, there won't be rate cuts, and most likely, in fact, we could either get more rate hikes and a hold of these rates, and that's one of the reasons why the bond yields have gone up. The yields are higher now, of course, as we've seen with the 2-year, but also, as you mentioned, the 30-year and the 10-year also moving up. So all the yields are kind of going up, whereas before this week it was just a 2-year outperforming. What this means is higher rates potentially for longer. That's what the bond market's signaling. And we've seen that actually correlate directly into mortgage prices already. So now I believe mortgage prices are about 7% again for a 30-year fixed jumbo for those in the US. Again, it's a little bit different, of course, depending on what country you're in. Even somewhere as close as Canada, it's a little bit of a different scenario because we have 5-year fixed. That's kind of the max that we do. So no matter what, every 5 years you're kind of on the hook for whatever rates are then. Whereas in the US, you get to lock in 30. So that can be amazing for those that locked in for 30 or anytime before 2020. Yeah. Man, I think so. Here's what you won't hear elsewhere. I think anyone that locked in for a 30-year before 2021, 2022, essentially just, again, not in their control, but just lucked into one of the greatest wealth building opportunities, simply because of being able to lock in a sub, 3%, 4% rate, even
it's
lower.
right around 3 or 4 here in the US.
That was huge. That alone can set people up for massive success, because right now, literally, it's costing double for anyone that wants to get something. Their affordability is lower, inflation is higher, rates are higher, housing prices they've gone a little bit lower depending on where you are from state to state, and even city to city in individual states. But man, it's brutal out there. So again, there's a little bit of a lag. I think eventually we're going to see more supply come in. Right now, there isn't too much supply in the housing market. Once that does increase, we're going to see prices go lower. And as of right now, the consumer is still quite resilient. So that's what's interesting. We got a lot of these different dynamics coming together. It's not as clear cut as how it was in 2008, 2009, where, oh, unemployment's going up. Oh, jobs openings are down. Oh, rates are coming down. Oh, the economy is slowing down. GDP is going down. Oh, stock market's down. Everything's down. It's not as clear cut as it was before. So we're in a bit of a conflicting environment, and we have been throughout this entire year. Hence why markets have taken a more of a bullish turn, because they're betting the stock market specifically is more from a point of thinking, well, we maybe leapfrogged a recession here.
Yeah, that's a really good point, and I can only speak to my area, obviously, where I live, because I don't look at housing prices in surrounding cities. But yeah, I would say that prices are coming down a little bit. But the thing is, like you're talking about, is there's a supply issue. The people who locked these mortgages in at that 3-4% ain't going to let them go anytime soon. Even though they could turn a pretty nice profit. I'll say that I could do that on my house, but the wife and I have talked about it, and it's like, well, where are we going to go? And now we'd have to get a mortgage in like 7% range, and that's not really appealing. So it definitely is creating a bit of a supply issue or a bottleneck right here, at least in my area right now. So that's kind of interesting to see happen in real time. Looking at the dollar here, not really too much to talk about. We're pretty well hanging tight. Yeah, we took a little bit of a dip here towards the end of the week, but honestly, we're no further down than we were a week and a half ago. So really not too much to say here. I would say the dollar is holding on pretty well at this point. Wouldn't you say, Riz?
Yeah, it's again, none of that exuberant, I would say, crazy calls of the dollar crashing and weakening and not being worth. So again, once again, hasn't happened yet. It seems like every week we go, the dollar's still hanging in there. So who would have thunk, right? Maybe the U.S. dollar as a reserve currency and U.S. dollar as opposed to other currencies is still quite strong. Wow, who would have thunk, right?
Funny how that works, isn't it? Yeah. All right, now I alluded to this earlier. Let's take a look at what is happening this week as far as key dates, and we've got some big numbers being reported on Wednesday and Thursday. We've got the inflation rate month on month and year on year being reported prior to the open, and then the core inflation rate as well. Those are going to be some big numbers that are going to push the market one direction or another, depending on how they come in and whether we see a hold as far as inflation is concerned, or we actually see a decrease. That could obviously affect the market. And then Thursday we've got the PPI, which is the Producer Price Index, month on month is going to be reported. That'll be an interesting one. Pretty sure this Friday is a non-bow. I don't think you're going to have to worry about that. Nothing burger. That's what I meant to say. But yeah, man, Wednesday looks to be like a big day for the market as far as critical dates.
Definitely going to be a big one. And we see that, every couple of weeks where one day is a highlight day. And that's definitely the case here on July 12th.
Yeah, it was like the other week we had Powell talking, and so that was always a big day. So yeah, they seem to like to jam them on Wednesdays, it seems like. We don't see anything going into Friday for the most part as far as key dates, but man, it's like Wednesday and Thursday, like, yeah, let's get our bad news in the back half of the week.
Yeah, one thing I will add on this Wednesday coming up on July 12th, also, I'm 90% sure is also the Canadian rate decision. So the Canadian Central Bank will also make a rate decision. I believe they too are kind of teed off to raise rates by 25 basis points. They actually held rates again last time around, just similar to the U.S. So the Canadian Central Bank actually is a little bit of a leading indicator to the U.S. rates, because we have the Canadian Central Bank this Wednesday coming up, and then I believe it's the week after is when the Fed, the U.S. Central Bank, is set to decide on rates. So once again, it's going to be similar. I think the Canadian Central Bank raises by 25 basis points, and then I think the next one for the U.S., they do the same.
Yeah, I have to agree with you on that. And I do recall the Canadian banks held interest rates, steady before the U.S. banks did. So it's a good point.
Yep.
Somewhat of a leading indicator.
Yeah, and the economy, GDP came in really strong for the print after. So it's kind of like we're kind of both in the same kind of pond here, for better or worse, the U.S. and Canada, whereas we see a little bit of a different scenario, different market, different economy out over the other side of the ocean in Europe. But for Canada, U.S., North America, we definitely see kind of a similarity in terms of strong, resilient consumer, strong economy, and of course a strong stock market as well for the year, and rising interest rates. So very similar economically in that sense.
Absolutely. I would like to encourage all of our people who are here on the live Elite webinar, all of our Elite members. If you have questions for Riz, start posting those up. I did get sent a question by one of our members. He says, hey, Chris, I'm stuck working tonight. Sorry about that, brother. So he missed the webinar, but he did want to put a question in for Riz. He's curious about being more aggressive with, writing short puts in a bullish market environment. He says so far he's been really successful writing them more conservatively, and he wanted to be ready for the possibility of a further uptrend if we should see that. Riz, do you feel like this is a market that would be a good thing to do, that method and, be more aggressive with that, or is it more time to remain conservative?
I would consider being conservative. I know it's not something we want to hear, but the reason is twofold. One, if we do see a little bit of a pullback, that's going to negatively impact the short puts. Number two, and I think this is the key one, the implied volatility, which is what factors into increasing the premium, making those premiums that we collect juicier, is not there, right? So it's not there, not where I want to be, and it's not where it's usually in that statistical average. It's actually below. So it makes writing those short puts, doing short puts, even less enticing. And it's not going to stay like this. We have periods of where we have very low volatility, and unfortunately, that is that kind of time. Hence why I've been I would say, running a very lean ship and very limited amount of short puts. I don't like it because obviously that decreases our weekly and monthly income from a short put standpoint. But it's better to be cautious, better to be conservative, because we can get a double whammy where if we see a pullback on the market, then it will negatively impact our short puts. We get an increase in volatility that will also negatively impact our short puts that we've already written. So I'd rather wait till we get a bump in volatility, and thus that will make the premiums a little bit more juicier. And if we see a lower market go lower, that will also make the short puts juicier from a new position standpoint. So if we're already in, then it's going to negatively impact. But if we want to get in, we want to wait for those circumstances. Other than that, we can still do them, still do short puts as you've seen me do, but in a very limited manner and only when it makes complete sense. Otherwise, I don't want to be steamrolled trying to make a little bit of money on the income side and then eventually regretting and be like, shoot, I should have just waited. Maybe, I should have just gone more conservative. We don't want to be in that scenario. I'd rather make a little bit and be more safe than try and risk making a little bit more and getting steamrolled.
No, that makes a lot of sense, obviously, because obviously you're going to be increasing your risk the more aggressive you get. And if the premium just isn't there, the risk-reward ratio is not where you need it to be.
Precisely. Well said. And it just doesn't make any sense, right? I always say this applies to everything. I do, and I apply this to my life as a whole, and without dragging it on, I will simply say, for me, it's all about risk management. And I know it's such a played out term, but I manage risk. When people ask me, Riz, what do you do? I do a few things. So I always say, okay, well, I do this, that. But in simple terms, my job is to manage risk. Really, that's what it is. My job is to manage risk for myself and help manage risk, or help others in Elite and outside of Elite manage their risk. Right? That's the most simplest term. It doesn't sound flashy, hot, amazing, but that's really what we're doing. As whether you're a trader, whether you're a businessman, whether you're an entrepreneur, whether you are doing anything, your job is to manage risk. And I think that applies to something as simple as getting in a car. Your job is to manage risk, right?
Yeah.
You put a seatbelt on. How you drive is going to increase or decrease your risk factor of an accident. How you operate in the kitchen. Are you cross-contaminating? You want to be a little bit more cautious. You don't care. Do you wash your hands after handling meat? Like, those are going to increase or decrease your risk of getting food poisoning. So these are all things, that's how you want to look at it. And that's a little bit of a mindset shift. And some people are like, that's interesting to look at that way. But the reality is that's all we're doing. We're always managing risk. So when we invest in markets, when we place a trade, when we do short puts, whether we buy stocks, whether we short stocks, whether we, open up a business, whether we, go to work or quit or get another job, we're all managing risk. And if you look at it from that standpoint, I think we will be better served, a better suited to make better decisions.
Great discussion there, obviously, and a really good way to kind of bring it home. Talking about risk management, because everybody equates it to just the markets, but there's so many different things that we do in our everyday life that really comes back to risk management. And if we would apply those principles more so to our trading, could have some very positive results, even though it may not be, stacking bags every week. Sometimes that small, consistent, repetitive, positive gains can really make a big difference in the long term.
Yeah, I would say this exactly like you said, Chris. And another way I say it, you know, keep trying to hit singles because hitting
Yep.
singles with limited amount of risk involved, managing that risk, having a positive risk reward, and hitting singles, it might not be big, massive numbers, but if you were able to do that and stick with it and compound, in the end you'll get there anyways without taking more risk. It's worthwhile doing it this way because when you take larger amounts of risk, when you try and make money faster, when you have outsized returns, you're doing it more often than not by taking more risk. And having outsized risk will effectively increase your chance of ruin. The effective term is the risk of ruin. What's your risk of ruin? Meaning, what's the risk that everything goes south and it massively dents your, whether it's your business, whether it's your relationship, whether it's your health, whether it's your trading and investment account? What's the risk of ruin there? And when we look at it that way, reverse engineer that, the style and method that we use, I assure you, may not be the most fastest, may not be the most uh, exciting, but it is definitely the most lucrative and the most sustainable.
Absolutely. And that's what you want. If you want your money to work for you, you need something that is sustainable. And that's what we are teaching and preaching here in Riz Elite. That's why we do this, because we want more people to be financially independent and to be able to achieve their goals financially for the long term. All right, Nick has come in with a essay of a question here. Let me go through this. Okay, GIS. Let's get on that first, and then I'll read the rest. General Mills. Let's have some cereal. Looking into a long swing position, if we see a solid bounce off of 74.75 support following earnings drop off. Okay, yeah, it looks like earnings were good and we took a bit of a hit. Looks like though the revenue was a little lower than expected. All right, not going to catch a falling knife. Good decision, especially with the possibility of market downside. Yeah, very good. Ex-dividend date just passed on Friday. Company not going anywhere. What are our thoughts on this one? So yeah, I mean, General Mills, the bottom kind of fell off that. Who flushed the toilet at the General Mills, conference call? Because that's what happened on earnings apparently. And yeah, we are selling off hard, man. But I mean, look at that RSI. That RSI is way oversold at this point. So yeah, I mean, if we do get a solid bounce off 74.75, I would feel more confidence inspiring. But man, right now, you're right, Nick. This is an absolute knife catch if you want to take it here.
Yeah, I echo the sentiment that Chris said. It's definitely a slower mover. This is one of those kind of stocks where if you get a good entry and you just let it, sit, it's gonna hold, or it's just you're gonna be able to collect a dividend. It's not gonna go crazy like some tech stock, right? So you got to know what you're in for when you do allocate capital to such a stock. It is a lower beta stock right now, as Chris said, completely oversold. Yeah, the revenues were missed, but again, it's cereal. It's one of those things that I would classify this more of a defensive company. So it's good if we see an economic downturn, if we see markets pull back, it should drop less. It shouldn't drop as much or as significantly as, let's say, some of these high flying tech stocks. So from that standpoint, you got to know what you're looking for. Are you looking for something a little bit more stable? Are you looking for a little bit of a dividend, quarterly? Are you looking for a slower mover? Then yes, I would wait till see if we can dip below the 75, find a floor. But if those things do not sound appealing to you, then yeah, this wouldn't be the one, right? You really kind of want to know first and foremost what you're in for, what your I would say goal is. But not a bad play, not a bad company. Definitely, like I said, more of those companies many traders will overlook simply because they move slower and might not be as high flying. So it's something this is on my watch list. It's on my main watch list. I've seen this stock actually recently. It's funny you mentioned it, but yeah, I didn't personally see a position or like an entry point yet, so I held off. Similarly, not wanting to catch that dive.
Yeah, for sure. I mean, if we can hold 74, I feel like that would be a fairly strong indicator that we're doing okay. But yeah, if it breaks below that, that's a no-go for me, honestly, because I mean, then we're kind of looking at somewhere around 73, 72 before we get there. But yeah, like Riz was talking about, this is a rather slow-moving stock. I mean, especially if you look here, this just grind. Now, of course, obviously this is a grind up, but you know, what was it? Followed it, a nice grind down. So as they say, you got to grind that flour nice and fine if you want the best cereal. So, uh,
Also, another thing I will
yeah,
add, the market axiom comes to mind. Stocks usually take the stairs up and the elevator down.
yep, that is for sure. You just got to figure out where that ground floor is, and that's the trick, to say the least.
Yeah,
No, you're
getting in at
absolutely.
the ground floor is important.
Yeah, for sure. Or at least when it's going up towards the first floor, then that could be a good time too. No, Nick, you're absolutely welcome, and thank you for that very detailed question. That's actually really helpful because
Yeah,
that really gives us an idea of what you're looking at and what you're seeing, and that helps us out quite a lot. So for anybody who's wanting to submit a question, look to Nick because that was very well done. So really appreciate that.
100%, 100% agree. Yes, big shout out, Nick. That's fantastic. That's a very well worded question. Fantastic
Hmm.
question. It doesn't really matter the stock, but when someone can ask a question with a clear cut thesis and like
Yep.
what their thoughts are, what they're looking at, that allows us, Chris and myself, to answer it more uh, prudently and give a solid answer, right? Um, with instead of just saying, well, I don't know, like what about the stock?
Yeah.
That's just as generic as it gets. And I get why people want to ask that because they want to know what we think, but it's difficult to tell you what we think because we need the lens. We need an idea what angle you're looking at it from. And from that point of view, we can then dissect it. But not knowing what angle you're looking at it from, well, it's just a best guess at that point.
Yeah, for sure, for sure. Now, I had a question while we're sitting here, Riz, on this one because we talked about the ex dividend and stuff like that, which is obviously really nice. Obviously, getting that free money for just holding a stock. I've kind of noticed sometimes there's and this not always is not a hard and fast rule, but sometimes we see a bit of a dip in the stock price when it's dividend day. Is that because investors are looking at this as money going out of the company, or is it just more of a coincidence?
Good question. Yes, money effectively leaves the coffers or the treasury of the company, right? So think of it like the treasury has its own bank account, its own cash, its own cash flow. When money leaves that company in the form of a dividend, which is a cash, often then that decreases the amount of cash on hand. So usually we do see a little bit of a discounting in the stock price post dividend. Not always. It doesn't work one to one. It doesn't mean like
Hmm.
if a company pays 53 cents out in dividend, it's going to drop the price by 53 cents. Not always.
Yeah.
But more often than not, we do see a little bit of a depression in the stock or going lower. But that doesn't mean, every time a dividend comes out, it's going to subtract it from it.
That's true. That's true for sure. But I just had noticed that and I figured some other people might be interested in that.
Yep. Yep.
Awesome. Well, I'm not seeing any other questions come in from our elite members here on the webinar. So I want to go ahead and just thank everybody for coming out today on this weekend. I know it was a short trading week. Obviously, we got a full trading week ahead of us. Lots of dates, especially on Wednesday. Lots of big things happening. Lots of numbers being reported that we need to be aware of. So keep an eye on that. And otherwise, be ready. And we'll see you in the market on Monday. Thanks for coming out, everybody.